Slide 7 describes the importance of a group tax policy. As the reporting line of indirect tax is often to the head of tax, we assess during the workshop what has been written and documented from a tax policy perspective. We like to know how the head of tax has derived tax objectives from the company's business objectives. A tax control framework is a system to identify, mitigate, control, and report tax risks, and when this is signed off by senior management, rolling it out within the company becomes much easier. That is why, during the workshop, we focus on realizing integrated approaches, either with the tax function or, for example, internal audit. Slide 8 is about scoping the tax risks. What is considered an unacceptable tax risk? Setting clear boundaries for those responsible for performing tax risk assessments are essential for managing expectations. Note that these examples are for illustration purposes only. During the workshop, the example of a should level of comfort, that is a driver for certain listed companies, is subsequently tailored into a more practical VAT guideline. Slide 9 is about setting roles and responsibilities. It should be clear who the process owner is and what the responsibilities are of the various stakeholders. You can imagine that when a tax policy is distributed and signed off by senior management, executing change will become much easier due to the right sponsorship. Without a proper tax policy, it depends on your influence within your organization to kickstart any change. Often that results in a fragmented approach, as not all stakeholders can be convinced. The outcome is that this negatively impacts defining standardized and global procedures and controls. Slide 10 is about scoping of tax risks in more detail. There are a couple of elements that needs to be considered to determine the materiality of VAT risks. Absolute amounts are the alignment with the way a business control framework sets up a risk-based approach. However, a VAT control framework differentiates, as it is about paying the right amount of tax, but also about avoiding risks that impacts reputation. This slide shows an overview of some risks relating to the company's reputation and potential impact for various stakeholders, such as vendor and customers, but as well tax authorities and external auditors. As we see in our daily practice, often no VAT measurable goals are visible to the CFO, and a wrong perception exists about VAT numbers under management. It is often considered, wrongly of course, a cash in and cash out. As earlier shown, a 1% mistake can be material and impact shareholders' value. VAT neutrality has to be earned and is not a given fact.